Okay, let's dive into this. Welcome to today's Explainer, where we're putting on our financial mastermind hats to really decode the national ledger. I'm host 1, and I'm host 2. Today, we are breaking down revenue and capital budgets. Right, and at its absolute core, what we're talking about is a government budget, which is simply an annual financial statement. Think of it as a master plan showing the estimated receipts and the proposed expenditures of the state for the upcoming fiscal year. We're going to dive right into where exactly all that money comes from and where it goes.
Here is our structured mental map for the day. First up, we'll define public finance and then compare it to private finance.
After that, we'll track the outflow, examine the incredible escalation of that spending over time, map out the inflow of those funds, and finally, we'll break down the specific types of taxes. Let's get to it.
Section 1. What is public finance? Let's set the stage. Before we evaluate where the money goes, we really need to understand the playing field. Professor Finley Shiras defined it perfectly. Public finance is the study of the principles underlying the spending and raising of funds by public authorities. Translating that into plain English for our purposes, it's actually quite simple. It is the study of government income and expenditure. So, whether it's the central government passing a massive new infrastructure bill or a local state authority funding public schools, public finance is the engine driving the entire thing.
Moving on to Section 2, Public versus Private Finance, Macro versus Micro. Let's look at how an entire nation manages its money versus how you or I balance our own checkbooks.
The objectives, the massive credit limits, even the right to literally print currency, those are obviously vastly different at the national level, but the absolute crucial takeaway here is how expenditure is determined. A government decides its expenditure first. They say we need this much for defense, we need this much for healthcare, and then they figure out how to fund it through taxes and borrowing.
Which is the exact opposite of private finance. I mean, you and I look at our household paycheck first and then decide what we can actually afford to spend. It's a completely flipped mindset.
Section 3, the outflow. Let's talk about government spending. Since governments plan their spending first, we need to understand how the budget book is cleanly split into two distinct operational accounts. First, we have the revenue budget. This handles revenue expenditure. Think of it as the short-term running account. So the crucial point is that it covers the day-to-day functions incurred regularly just to keep the lights on, things like administration salaries, interest payouts, and general upkeep.
Exactly. And on the flip side, we have the capital budget, which handles capital expenditure. This is your long-term capital and debt ledger for building the future. We're talking massive-scale investments in infrastructure, purchasing new machinery, and even large loans given out to local states.
Now, another way economic advisors categorize this outflow is by its ultimate impact on the ground. We have developmental expenditure, which acts as a productive engine for overall economic growth. It actively creates jobs and funds research. In stark contrast, non-developmental expenditure doesn't yield a direct productive return. It's necessary, sure, but it covers things like basic administration costs, maintaining law and order, or, in the most extreme cases, the absolute massive financial drain of a war.
Section 4, the escalation. And this is where the numbers get wild.
If you've tracked global economies at all, you know the scale of government spending is aggressively expanding. Now, what's really interesting about this slide is the sheer jump. In India, back in 1991-92, public expenditure was just over 72,000 crores.
Yeah, and fast forward to 2018-19, and that number has exploded to over 17 lakh crores. That is not just gradual expected growth. That really emphasizes the staggering, skyrocketing velocity of the modern state's financial footprint.
So why did those numbers explode to such heights? Let's quickly trace the real-world drivers. Obviously, we have a rapid increase in population, paired with growing urbanization, which requires massive new city infrastructure. And you can't forget increasing defense expenditures due to global instability. Plus the actual costs of spreading democracy through regular, massive elections. The constant, heavy pressure of inflation driving up the cost of goods the government buys, too. The huge push for industrial development. And, of course, the soaring costs of disaster management due to natural calamities. Simply put, running a modern welfare state is incredibly expensive.
Section 5, the inflow, funding the state. Which brings us to the inevitable multi-trillion-dollar question. How is this monumental level of escalating spending actually funded? Well, the government heavily relies on revenue receipts. That's the aggregate money coming in through both tax sources and non-tax sources to fund that short-term revenue budget.
Exactly. And to balance out that long-term capital budget we discussed earlier, the government relies on capital receipts. Those are the incoming funds from borrowings, central bank loans, and public market debt.
Let's start with the biggest revenue receipt of them all, taxes. Professor Seligman defines a tax as a compulsory contribution from the person to the government without reference to special benefits conferred. I really want to highlight the compulsory and non-transactional nature of that definition. If you don't pay it, you face legal penalties. And crucially, you aren't paying a tax to get a proportional direct return benefit. It's not like buying a coffee. You are funding the common, shared interests of society as a whole.
So what actually makes a tax system fair? And this brilliantly illustrates how Adam Smith, the founder of modern economics, established 4 absolute gold standards known as his canons of taxation. First is the canon of equity. Taxes should be strictly proportional to your ability to pay. Second is certainty. You need to know exactly what you owe and when you owe it. No hidden surprises. Third is convenience. The actual process of paying the tax should be, well, easy for the taxpayer. And fourth is economy, meaning the government shouldn't have to spend an absolute fortune just trying to administer and collect the tax in the first place.
Moving to Section 6, Types of Taxes. Direct versus indirect. We generally divide taxes into 2 totally distinct mechanisms. A direct tax is paid directly on your income or your property. With a direct tax, the impact and the incidence fall squarely on one person. You simply cannot shift that burden onto someone else.
An indirect tax, however, is levied on goods and services. The producer pays it initially to the government, but the burden is ultimately shifted down the supply chain to you, the final consumer. It's entirely built into the price of whatever you're buying at the store.
Let's move to and see how this builds out in the real world. To see this in action, we just have to look at India's Goods and Services Tax, or GST.
Right. It is the ultimate real-world example of an indirect tax. It was literally designed to consolidate and replace almost all other indirect taxes and customs duties. It streamlined the whole system into one unified structure that impacts every single good or service purchased.
Going back to direct taxes for a second, the structure is incredibly important for social equity. A proportionate tax applies a constant rate for everyone, completely regardless of their income level. Then you have a progressive tax, which is actually what many modern democracies use. It asks more from the wealthy, so the tax rate actually increases as your income increases. And conversely, a regressive tax ends up disproportionately hitting lower income earners. Why? Because larger incomes end up paying a smaller overall proportion of their total earnings.
Outside of taxation, the government also generates funds through non-tax revenue sources. This includes standard administrative fees, the prices you pay for public goods like railway tickets, and fines. And it's worth noting, fines exist to enforce the law, not just to turn a profit for the state.
Absolutely. And don't forget borrowings. As we mentioned earlier, central bank loans and public market debt actually fall under capital receipts. They add to that long-term capital budget to help fund major nation-building development.
This brings us to a massive, structural debate about the 3 main types of budgets. How do we balance this giant scale? I mean, can we ever have a true balanced budget where estimated government revenue perfectly matches proposed spending?
It is incredibly rare. Sometimes you might see a surplus budget, where estimated revenue actually exceeds planned expenditure. Now that's really useful for cooling down high market inflation, but the massive downside is it can severely lower general economic growth.
Exactly, which is exactly why developing nations heavily rely on the third type, a deficit budget. That's a scenario where proposed spending intentionally exceeds estimated revenues. You do it to actively pump money into public welfare, generate jobs, and stimulate growth during economic slumps.
But that leaves us with a huge question. If a modern welfare state's spending must continuously escalate to support its citizens, is the heavy weight of public debt the only way to balance the national ledger tomorrow? That is a very real challenge every developing economy faces. Thank you so much for joining us for this explainer.